carefully. This is very important to understand how the financial accounting and a business workflow works. This will also act as a basis of understanding to you guys as to how financial accountants perceive a business and how they understand what drives the business profit and growth. Okay, so here is the pillars of financial accounting building blocks. Why I call it building blocks is this will allow us to take another step to understand the intricacies of financial accounting. But this is in a pure sense of a layman language, which will help you to understand how the business functions from the background. Okay, let's understand the three concepts in business. First is cash generation, the second is return on asset, the third one is growth. I'll break it down one after another so you will have a good understanding of what we are talking about and what we will talk about this in future. Let's first understand and dissect what is cash generation. Cash generation is any activity which gets cash into the business. Very simple, right? Any activity which allows a business to have money in their hand is called cash generation. There are different ways a business generate cash. One of the source is accounts receivable. When we say accounts receivable, that is anything which is to be receivable from a third party. That could be a customer or a loan from bank or someone have taken some credit from the business and they have to pay us back. Okay, that is one of the major activity of the business without which the business will not survive. The next is accounts payable. So what a business in simple does is they receive money from customer and pay partly or fully to their suppliers. What is left between the accounts receivable, which is received from the customer, and what is paid to our supplier is the net cash business holds. Okay, remember, this is not the profit of the business. All right, this is just the cash, net cash. So what are the cash inflows which gets into business? That is sales to customers, loan received from bank, or loan received from a third party. Clear? Let's go to the next one. Cash outflows. Cash outflows are all the expenses and payable to be paid to a third party or to employees in simple. For example, payment to a supplier, payment to employees, payment to buy an asset, payment to buy inventories, payment to buy any kind of services. Any penny goes out of the business is considered as cash outflow. Okay, so the whole concept of cash generation revolves around accounts receivables and accounts payables. Accounts receivables is something which we receive from customers or third party, and accounts payable is something which we pay to the stakeholders, the partners like suppliers and employees. Clear? Let's jump on to the next one. Return on asset. What is return on assets? To understand what is return on asset, let's understand what is an asset. Asset is a machine or a building used to generate or produce a product or services. For example, there is a manufacturing machine which produces shoes, 100 shoes in a day. That machine requires a lot of investment, like you don't buy machines every day and it requires a lot of investment to be done. So maybe $100,000 is spent on a machine. So when you get that machine, it allows you to produce shoes if you're selling shoes. That machine is considered as an asset. So folks, there are two kinds of asset. One is tangible asset, one is intangible asset. In simple terms, tangible asset is an asset which you can see with your bare eyes, which is physical in nature, you can touch and feel. There is another form of asset which is called intangible asset, which is also one of the very important pillar of an accounting, which is like the brand value of the company, the if the company is doing some research, the intellectual properties, the copyrights, patents, goodwill in the market, if you are known for doing ethical business, that is also considered as an intangible asset. So the assets are classified into two types, tangible and intangible assets. Example of tangible assets you can see equipments and tools, buildings, etc., which you can see, feel, and touch, which will help you to generate some economical value in the business. Intangible assets which you cannot see, something like brand, trademarks, know-how. Know-how means the knowledge and expertise you have in something. For example, if you have an employee working for you for 20 years, he has specific skill set and experience from your company, gained from your company, and he is working for your company from last 20 years. So his knowledge and competencies are considered as know-how. and copyrights, for example. Now, if you see the table here, the cash generation plus the return on asset gives to growth. So how growth is measured? The amount of cash you have generated after removing all the payables plus what has asset produced to you equals to growth. So if both of your elements in the business work hand in hand to get the final product and sell that into the market, then you will automatically move towards growth. Okay, what is growth? If your assets are working, functioning properly and being utilized properly, and your accounts receivables means sales is doing pretty well, and you are able to ensure that your partners and suppliers are being paid on time, then you will have more sales, right? So if this whole system works properly and efficiently, the targets will be achieved. What you are anticipating will get into reality soon, right? Once we have more sales, what will be our target? Our target is to have profitable sales, right? This is very important. Most of the employers and managers forgets that we have to focus on profitable sales rather than just sales, because doing good sales, achieving target is the basics of surviving into the business. But targeting on specific product which is giving you more profit is the next level of understanding which you have to build within yourself to ensure that you are focusing more on profitable sales. For example, I have observed from my previous experience in retail sector, the incentives are generalized usually. It will be given if you achieve the sales. But in retail, if you have a T-shirt, for example, at a cost of $100 and you're selling that at $150, and there's another T-shirt which is costing the same $100 and you're selling it for $125. Here you are making only $25 as profit, but whereas the T-shirt which was uh, previously discussed, which was selling at $150, earning you $50 profit. So if you go to your salesperson and say you focus on T-shirt A, which is selling at $150 and giving you $50 profit, then you will focus on selling the product which gives you maximum profit than focusing on the product which will give you less profit. Besides, we can also pitch to customer any additional services which will go hand in hand with your main product to enhance the profitability. For example, if you go to the McDonald's counter and you ask for a meal, a normal dinner meal, let's say for example, the customer service representative will definitely ask if you would like to add apple pie or any other drink or mojito or something of that sort. Why they are pitching you this? Because they wanted to focus on things which gives add-on value or more sales. So it is very important that we focus on profitable sales and sell the product which gives more profit to the business than focusing on and employing our resources on products which are giving less profit. Then if we have more profits and then we have more sales, the automatic focus of a business entrepreneur will move on to investment in machines, using the surplus for innovation. For example, if you are using a old age technology, if you have free cash flow in the business, then you might also think of getting the latest technology into the business. So it is important that you are flourishing into the business and keep on innovating your business and inventing new method practices and adapting to the new technology, so you make more profitable sales. So this becomes a vicious circle automatically. Once you have a good system in place, good cash generation, good return on asset, means your assets are technologically advanced and they are really working well, then you might as well think of expansion, right? This is an automatic transitioning of from a basic concept of selling, surviving, then profits, then investment into your own people or machines, and then expansion, finding the new markets. But the growth happens only when two of your concepts works very well together. Your employees, your sales, your branding, your marketing is doing everything possible to get maximum amount of sales, cash generation into the business. Then your assets are helping you to achieve the production set forth and anticipated by the management. Okay, so what we have discussed earlier, the cash generation and the return on asset give rise to growth. This is how we perceive as financial people the same model of business translated into financial language. So now it will become very easy for you to understand what we perceive in accounting. So it doesn't look like rocket science anymore. So see here, there are assets. What are assets? I have already discussed. Assets are the machines, the building, the cash which we have in the business, which will help us to generate economical value for the business, which helps you to produce the product or produce the service, whatever. So what is asset? In our language, in financial language, assets comprise of both tangible and intangible. Remember, I told you intangible assets as well, which are copyrights, trademarks, brand, your brand value, goodwill, etc. Tangible intangible items that holds monetary value alongside cash, bank balance, and money owed from customer, that is accounts receivable. So all this combined together, assets and receivables to the business is considered as assets. Okay. The next point two is liability. What is liability? Liability is something which we owe to others. It could be a supplier, it could be a bank loan, it could be salary payment to an employee, whatever. So liability comprises of debts owed to outsiders, accounts payable, and other obligations that needs to be settled in the future. Okay, clear? The third one is equity. Equity is what remains for the company after all liabilities have been paid off. It can be calculated as the difference between company's total asset minus company total liabilities. For example, let's take your normal example. Let's say you are a salaried person and you earn a salary of 25,000, of which you have to pay your mortgages, loans, etc. for 5,000, rent 5,000, and utilities and groceries are 5,000. So in total, you are spending 15,000 and you're saving 10,000. 10,000 is your equity after making payment from your inflows. Similarly, if you own a building, if you own a car, if you own some gold jewelry, so all the cash which you have, so if you combine all this, your car, your house, your jewelry, the cash which you're carrying, if you combine all of this, it becomes asset. Minus, if you have any loans outstanding, credit cards, or anything payable to someone like your maid or salaries to your gardener or rent or any contracts which you have done which you have to pay, if you remove that, then that becomes your net worth or equity. Equity or net worth is what you have after combining all the assets, all the cash minus all the payments to be made to others. Clear? So if you remember that previous sheet where we have discussed cash, return on asset, and that gives rise to growth. Similarly here, assets minus liability give rise to equity. If your equity is positive, means you have more assets and less liabilities than your business having a positive equity. Positive equity means you have free cash flow. Free cash flow means you are entitled for making growth plans like expansion, innovation, introducing new technology, etc. Similarly, if your assets are less worth than the liabilities, means if you have $100 worth of assets, whereas you have a liability of $120, that means you have negative equity. In this scenario, the business can either go bankrupt or business have to pump up the money from an outside party like a shareholder or a business owner or bank to uh, to help the deficit and compensate the deficit and get some money into the business, to run the working capital, which I will discuss later, working capital, to get some working capital and infuse some working capital into the business and get the business going.